Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about risk regulation in banking industry. It is Module B Risk Management Chapter 10 Risk Regulation in Banking Industry of CAIIB. Now in this chapter, you will learn the necessity of regulating banking business, how regulations affect banks, goals of regulators in regulating banking business, systemic risk, cross-border regulation 1988 Basel Accord, 1996 Amendment to Basel I Accord, and Basel II Accord. Now, if we talk about regulation of banking industries, what is the necessity and what are the goals? Now, taking is not regulated properly. The banks may fail and it would have a disastrous effect on the economy. Therefore, the monetary authorities, the central banks of the country, have to take care and manage the risk in the banking business. Now, let's talk about systemic risk. Now, systemic risk is the risk of failure of the whole banking system. An individual bank's failure is one of the major sources of systemic risk. This happens because of higher interrelations that exist on an ongoing basis between banks through mutual lending and borrowing and other commitments. So, systemic risk is basically depending upon each other of major banks. So, if one bank fails, the entire banking industry collapses. So, why BCBS banking codes or BIS Bank of International Settlement? Now, due to the different time zones, there was a lag in dollar payment to counterparty banks, during which Bank Herstat, HERSTATT, was liquidated by German regulators. The risk of settlement that arise from the time difference came to be known as Herstat risk, because of which the Bank of International Settlement uh, held a meeting with 28 countries. Now, the BCBS has been instrumental in standardizing bank regulations across jurisdiction, with special emphasis on defining the roles of regulators in cross jurisdictional situations. Now, let's talk about all the Basel Accords in brief, which are only relevant and important from the exam point of view. Now, Basel I, the Basel Capital Accord, in 1988, Basel Accord primarily sought to put in place a framework for minimum capital requirement for banks that were linked to credit exposure. Bank assets were classified into five buckets and grouped under five categories according to credit risk, carrying weights of 0, 10, 20, 50, and 100%. Generally, government debt was categorized as 0%, bank debt as 20%, and others at 100% risk. The accord provided a detailed definition of capital. Tier 1 or core capital, which includes equity and disclosed reserves, and Tier 2 or supplementary capital, which could include undisclosed reserves, asset revaluation reserves, general provisions, and loan loss reserves. 1996 Amendment to include market risk. In 1996, BCBS published an amendment to the 1988 Basel Accord to provide an explicit capital cushion for the price risks to which banks are exposed, particularly those arising from their trading activities. This amendment was brought into effect in 1988. Now, if we talk about Basel II Accord, what was the need and the goals of this accord? Now, credit risk assessment under Basel I was not risk sensitive enough. The capital requirements not differentiated based on risk characteristics of asset. It did not recognize the role of credit risk mitigants. So, to overcome this, the Basel II Accord was formulated in June 1999, wherein a proposal for new capital adequacy framework to replace 1988 Accord. Now, this led to the release of revised capital framework in June 2004, which is known as Basel II Accord. So, this is important. The revised framework now comprises of three pillars. First, minimum capital requirement, which all banks have to maintain, supervisory review of institutions' capital adequacy and internal assessment process, effective use of disclosure as lever to strengthen market discipline. So these are the three pillars. So the Basel II Accord is mainly based on three pillars, which is minimum capital requirement, supervisory review process, and market discipline. Now, all these three parameters, these three pillars can be measured through various approaches. So, if you have to measure the pillar one, which includes the minimum capital requirement, it can be measured through capital for credit risk. And capital for credit risk can be measured through standardized approach, internal rating based approach, which is foundation approach, and internal rating based advanced approach. So there are three ways through which capital for credit risk under minimum capital requirement pillar 1 can be measured. Now, capital for market risk under pillar 1 minimum capital requirement can be measured through standardized approach maturity method, standardized approach duration method, and internal models method. And capital for operation risk, which again comes under pillar 1 minimum capital requirement, can be measured through basic indicator approach, standardized approach, and advanced measurement approach. Now, what is pillar 2? Now, pillar 2 is supervisory review process. It evaluates risk assessment, ensures soundness and integrity of bank's internal process to access the adequacy of capital, ensure maintenance of minimum capital with prompt corrective action for shortfall, prescribe differential capitals where necessary, that is, where the internal processes are slack. Now, pillar 3 is market discipline, enhanced disclosure, core disclosures, and supplementary disclosures timely and semi annually. So, pillar 3 is all about disclosing to the people. Now, banks in India were required to maintain a minimum capital to risk weighted asset ratio, which is called CRAR, of 8%. However, with effect from year ending March 2000, banks are required to maintain a minimum CRAR of 9% as per RBI guidelines. So, I hope this concept is absolutely clear to you. And once you go through this chapter, you will realize that this is what is covered in the entire chapter, and this has a broader understanding. If you want to go into the details, you can definitely go. However, this itself is quite enough for the purpose of clearing the examination. Now, let me give you certain aspects and very important questions which you can definitely answer in the description box below. Let me ask you those questions and let me see how much you have understood. Question number 1: systemic risk is the risk of. Question number 2: central bank governors of G20, G10 countries participate in Basel Committee on Banking Supervision. The total number of members are 1988 Capital Accord Framework accounted for. Okay. Back testing is done to. Next question. Under Basel II, capital requirement under the accord is. Next question. Capital charge for credit risk requires input of. Next. Under the standardized approach, the rating assigned by the eligible external credit rating agencies will largely support the measure of. Okay, so these are some of the important questions which I'm sure you'll be able to answer. Even if you're not able to answer, that's okay. You can read, focus, come back again and again try to answer these questions. So the more questions, the more summary you will revise, you'll be able to get a broader understanding and a much better level of confidence to clear this exam. I think confidence is the key to get over this exam. So if you like this video, I'm sure you will definitely uh, like, subscribe, and share this video in the social media. Thank you. Have a great day. Bye bye.